Hey guys, welcome to Infinite. The year 2021 so far has been the best year for IPOs as there were 51 IPOs listed till now, including Zomato, Paytm, Nykaa and many others. In this video, we'll see what is an IPO and what are the process followed during an IPO. IPO, an initial public offering, is the first time a company issues shares to public. This is when a private company decides to go to public. In simple terms, a company that was privately owned until then becomes a publicly traded company. Before IPO, a company has very few shareholders, including founders, angel investors, and venture capitalists. During the IPO, the company opens its shares for general public. As an investor, you can buy shares directly from the company and can become a shareholder. How are shares allocated? There are different categories when it comes to IPO. First, institutional buyers. Second, non-institutional buyers. And third, retail investors, also known as general public. As an individual investor, you are allowed to invest in small lots worth Rs 10,000 to 15,000. You can apply for maximum of 2 lakh. The total demand of shares in retail category is judged by the number of applications received. If the demand is less, you are offered a full allotment of shares. When demand is more, for example, sometimes an IPO can be oversubscribed as much as 5 times. In such cases, the shares in retail category are offered to investors on basis of lottery. This is completely computerized process. So when does a company goes public? To raise capital for growth, allowing owners and early investors to sell their stake to make money, and for the greater public awareness. What is the procedure of IPO for a private company? Selecting an investment bank. The role of investment bank is to help company establish A. How much money the company hopes to raise, B. Type of securities offered, and C. To determine initial price per share. Second step is to create the red herring prospectus. This is done with the help of underwriters to check prospectus including financial records, future of the company, potential risks in the market and expected share price range. Third step is SEBI approval. Securities and Exchange Board of India, if satisfied with the prospectus, then it greenlights the IPO and also gives date and time for the IPO. If not satisfied, it asks company to make changes before prospectus can be shared with public investors. Fourth step is subscription status. Once all formalities are done, the company makes shares available to investors. Investors who wish to apply for shares must fill out and submit the IPO application. The last step is listing on stock market. Listing is a process where securities are allowed to deal on a recognized stock exchange. Example, BSE and NSE. The shares are allotted to different investors based on demand and price quoted in application forms. Investors get shares credited to their demat account. How can you benefit from IPO? First mover advantage, as you are investing early in a company. High returns if the company has a potential to grow. Buying shares will benefit you. Listing gains. When the opening price is higher than the allotted price, it is known as listing gains. Here are the two recent IPOs which made quite a lot of buzz in the news. Shares of Nykaa made a strong market debut on the Indian stock exchanges. The stock started trading at a premium of 82% at 2,054 per share on the NSE as compared to its IPO issue price of 1,125 apiece. Paytm stock listed at 1,950 per share on NSE, a 9% discount to compare to its IPO price of 2,150 apiece from its issue price on its first day. To sum up, IPOs are big events in the stock market for a reason. By investing in right company, you stand a chance to earn good returns in long run. But the trick is to identify the good performers from the rest. Hope this video helped in understanding the concept of the IPO. Please share the video with your friends and family members. If you haven't subscribed to our channel by now, please subscribe to our channel for more interesting videos.